Right. Well, good afternoon and welcome everybody. Yeah, I got my coffee motivation going. I've already drank my coffee and ready to go. So welcome everyone to Trading Coach's Playbook. My name is Brandon Waddell and I'll be your host as I guide you through, the topic today is correlations and how we can use those to help us out in identifying trading opportunities as well as warning signs and all kinds of good stuff. Actually, you use it quite a bit in trading pretty much any security. Doesn't matter if you're trading Forex, it doesn't matter if you're trading futures or even stocks, even options on stocks. Or options on futures or options, anything. There are a lot of relationships out there when it comes to these markets. Understanding those relationships and using them to your advantage gives you literally an advantage over other traders. So good morning, Helen. Good morning or good afternoon, Kevin, and welcome, Stephen. Welcome everybody actually to this session. Before we get started, just need to remind everybody, we are educators. We are not brokers or investment advisors. So when we look at the information, we take a look at the markets. We're simply doing it from an educational standpoint only. I will look at live markets, but I am not telling you to buy, sell, or hold any particular securities. Okay. Oh, good morning, Jim, or good afternoon, Jim. Welcome. Anyway, I'm not giving any personalized recommendations or telling you to buy, sell, or hold anything in particular. And there's also risk of loss in the markets. No matter what we do, we can never eliminate that. We can just try to manage the risk. And also, we're not subject to trading restrictions here, so I could have a position in a security or initiate one at any time. So that being said, and the lawyers being satisfied, you can see we're pretty busy here. We got a lot of programs at Wealth Builders HQ. So we have premium workshops that obviously you have to enroll in. There's a lot of free workshops. You could join us Monday at noon. Every Monday, Rob does Power Hour. And there's also this Trading Coach's Playbook every Friday, except for next Friday, I think it is Good Friday. So obviously holiday. And I've got one coming up too called Top 3 Strategies. You're more than welcome to join me on April 3rd at 8 p.m. and April 5th at noon Eastern. And I'll be doing some free workshops there as well, bestowing some new information on you. And one of the programs I'm very involved in, and I'll talk a little bit about today, is the E-mini Think Tank. And basically we meet 3 days a week on Mondays, Wednesdays, and Thursdays from 9 a.m. to 11 a.m. And we look at the futures markets and understand better how to analyze them and find trading opportunities. So you can stay in touch with us as well. This is all of our contact info. I actually also have my Twitter at TraderBdub. And you can follow me on YouTube and all that good stuff too. So as I was mentioning, I run quite a few programs here. I'm pretty busy. Got the E-mini Think Tank that I'm quite involved in. I got Wealth with Spreads, the SPX Cash Flow Secrets, and even Futures Boot Camp for those of you who are new to futures trading and want to learn how to trade it. Maybe you haven't done it before. Maybe you only dabbled a little bit and need some more information. The Futures Boot Camp is a great place to start and gain the knowledge you need to be more confident in analyzing those markets. But as I said today, we're going to be talking about following the market leader and what we call relative strength. Now, I'm not talking about the RSI. Okay, RSI, Relative Strength Index, is only measuring the strength of a security against itself, right? So if we take a look, I have a bunch of charts open. I almost always have my RSI, and I've done workshops on that in the past, and I will do more in the future. But that RSI is only measuring the price movement of this security against itself. How bullish is it when it moves up? How bearish is it when it moves down? And I look at it as a measurement of momentum, basically. But that's not what we're talking about here today. Today, we're going to be looking at relative strength between two related securities. And as I said, it could be futures, which is the way I use it quite often, almost pretty much every day. You'll see I have quite a few charts, and one of them that's very important to me is this one. So I can look, for instance, it's a 5-minute time frame, and I can go back to this morning at the opening bell at 9:30. Yep, happens to be right there. And this will tell me which of the futures index, equity index futures, it'll tell me which one happens to be leading us. And we're going to talk about why that's important and how to use that. So it's probably better. This doesn't show the labels, but if I go here, you see, oops, I just passed it. There we go. This is very similar. Again, if I go to a 5-minute time frame and go to this morning at 9:30, there it is. pretty much the same thing, but now you can see I've got the labels there, which is pretty nice. And it shows me how all four of these equity indexes are moving in relationship to each other. So one of the first things, and you saw that on the slide, is we need to figure out the time frame that we are working with. So as a day trader, I might use intraday charts, perhaps as little as a 5-minute or even 1 minute if I really want to see the immediate momentum in the markets. However, if I'm an investor or looking at bigger picture, I'm not going to be caring about what goes on intraday. I'm going to be trying to figure out, okay, what trend are we in? And, who's leading us in that trend? So for instance, if I'm an investor and I'm looking at ETFs, let me switch this over to say SPY, right? And I can adjust the others as well. Let's see, for this, we could do QQQ. It only takes a moment to switch them. For the Dow, we can use diamonds, DIA. So I'm using the ETFs that track those particular indexes. And we have IWM for the Russell. And there we are. But now, rather than staying, and I'm going to clean this chart up. There we are. Rather than staying intraday, I can go out to a daily chart. And before I get started, again, I'm looking to see long-term. Let's say I'm an investor. So we go weekly, perhaps. What I'm going to need to do, though, first is figure out what trend are we in and who is leading us in that trend. When did it begin? So if I go to a weekly chart on the SPY, for instance, well, we're not really in a great trend right now, honestly. You can see that we're pretty choppy, kind of moving up, right? We have higher lows, higher highs. We haven't made another one yet, but it looks as though on the weekly basis, we really started this on October 10th, right there. So Monday, October 10th is the origin of that rally. And I can check on the other ETFs to see if it's very similar. Again, clean this up. And it looks as though, yes, October 10th is a low also on the NASDAQ. We've had higher lows since. And for good measure, I'll go to the diamonds. Again, clean the chart. And it looks as, yep, we do have that low, same on the 10th. And finally, IWM. And same. So we're pretty safe seeing that all of the bullish trends, although this is not in a bullish trend, you see we have a lower low, so we can't physically be in a bullish trend here on the Russell, but the others are. But they all began on the weekly basis, pretty much second week of October. So once again, I go back to my comparison chart, go to a weekly chart, and there's the October 10th, had it marked already. And there, we can compare these securities now to see who is leading us when we move up and who is leading us when we move down. So basically what I'm doing here is finding an anchoring point. I'm trying to anchor the comparison at either major high or major low, whatever has really kicked off the trend that we are currently in. That's what I'm trying to determine. Sorry, battling a little bit of a head cold here. So that's what I'm looking for, major high or major low for the trend that we are currently experiencing based on the time frame that we're trading. And it's kind of different depending on what it is you're trading, right? If we're trading intraday, we might be using intraday starting off from the opening bell, or if we're trading energy markets, you can compare those. We could do crude oil, heating oil, gasoline, and do a comparison from the regular trading hours opening bell, which would be 9 a.m., not 9:30 like the equities. So it's important to know your securities. Also, if we're doing currencies, you can compare the currencies against each other, right? And if we're comparing currencies against the United States dollar, maybe we use the euro, we can use the pound, the, Aussie, and the Kiwi. And the reason why I chose those is the US dollar happens to be the quote currency in all four of those pairs. Okay, you got to be careful because if you try to compare euro dollar versus dollar yen, Now you're reversing the quote and base currency. So you're not really comparing apples to apples. Well, the futures you get in that case. In Toss, Thinkorswim, I actually have the directions on how to do that in my E-mini think tank. Again, I mentioned E-mini think tank is a pretty comprehensive program. I just passed it. There we go. So if I go into my members section on E-mini think tank, what happens is we have a lot of live courses. Obviously, I do those 3 sessions every single week, Monday, Wednesday, and Thursday for 2 hours. But there are also bonus videos and education. So you see the bonus videos from sessions I taught, and one of those is, I believe, not sure where it is, something on follow the leader or comparisons, but I do know if you go down here a little bit, let's see, is it in here? No, maybe it is under other strategy. There it is, yes. Percent comparison instructions for Thinkorswim. Okay, so you can do it on multiple platforms. As you can see, I use a Mega Charts, I have TradeStation, TradingView, Toss. So I have the directions written out. I'm not going to go through all the steps right now, but it's not that hard. Honestly, on Toss, you just have to go into a chart, and under the studies, you do, I think it's add symbol or compare symbol, something like that. So you'll see it in your studies. So you just bring up a chart. I don't have that open right now, so I'm not going to bother. But yeah, you have directions on all that stuff. Again, if I use it, I teach my students how to use it as well and the importance of it. So like I said, we need to figure out the beginning of a trend, and we do that from the individual price charts. So as I was saying, if I wanted to compare currencies, same thing. I would go to an individual chart, perhaps Euro, US dollar, Forex, and we can see right now that the Euro versus US dollar has been rallying pretty much since late September. Sorry, my dogs are coming up to me. They want attention. So if I was doing comparison of currencies, I might start on the 26th of September based on the weekly chart. And I can check to see if it's the same on the pound dollar. Yep, looks pretty similar. Aussie dollar. No, that one's a little different. It didn't bottom out until October. So we have to be careful with our comparison. You know, if I try to use that September 26th on everything, it's not going to be quite the same for the beginning of the move from the currencies down under. And as I mentioned, if you go to dollar yen, oops, JPY, it's going to be reverse because now the US dollar is in the base currency position, right? So let's get back over to our comparison chart. And basically what we're looking for here, just going to switch over. There we go. What we're looking for, again, we figure out where we want to start the study, and based on the type of trading we're doing, either intraday or long-term, we choose that chart, and we figure out the beginning of our trend, either an uptrend or downtrend, and we anchor the study at the beginning of that trend, okay, or beginning of a day. If you're using regular trading hours, stocks, it's easy, right? Everything starts at 9:30 when the bell rings for the most part. Then what we're going to be looking for is who is our leader. And what we're looking for specifically for that leadership, who is making higher highs first during that particular time frame, or if we're in a downtrend, who is making the lows first in that particular time frame. So we want to look to see, for instance, here that spiders versus Qs, all those ETFs. Initially, you see the black market right there from the lows in October. It was the diamonds or the Dow that was leading us off the lows. That was the leader to the upside, while the NASDAQ appeared to be the leader to the downside, and it was the weakest market. So we need to identify the bullish leader, basically which market is making the new highs first. And of course, I can't spell today. That's pretty much every day. But which market is making the new highs first? And of course, for the bearish leader, which market making the new lows and making them first. And the reason why we care about the leader both to the upside and to the downside is, I don't know if you've ever been trading and you're watching a security. There will be times where you're watching it and you're expecting it to turn at either a demand or supply, or if you call it support resistance, whatever you look at. Sometimes prices turn just before you hit that level. And you're probably wondering, oh man, why did I miss that? Why didn't it not turn at my level, turn before? Well, perhaps you were not looking at the leader. The leader is the one that usually dictates when the trends are going to be changing. So for instance, if we're looking in an uptrend, the bullish leader will hit supply. And again, I use things like supply and demand. It's a little bit different than support resistance. Once more, there's explanations and information on that in the E-mini think tank. So, but typically that bullish leader will hit supply and cause all of the related markets to turn. Even if the related markets aren't at the supply zone. And of course, the opposite is usually true. When we hit a bottom, often the leader to the downside is the one hitting a support or demand, not the followers. And once that leader hits, yeah, everything tends to turn around. So in a downtrend, the bearish leader will hit demand. Actually, don't need a comma there, and cause all of the related markets to rally, even if they are not at demand themselves. Yeah, it's just because securities are related. They almost always have something related to it. And there's a lot of ways of figuring out what is related. You can use correlation studies on your charts and throw a couple securities up. You know, for instance, here, if I go into a chart and let's do XOM, it's ExxonMobil. Let's do it daily. And I can add in, and here it says compare symbol. I just hit that little plus sign. It's easy on this one. CVX. I think that's not, yeah. It's because I'm not in stocks. Chevron Corporation. And you see I put them together there. I can put them in separate panes, whatever I want to do. But when I go to indicators, correlation coefficient, and there's several of them out there you could use. And this one I'm actually comparing to, there we go, CVX. So I didn't necessarily need to have the other chart here. You can see the correlation coefficient between the two securities. It's hovering right around 90 to 100%. You know, currently they're at 98% positive correlation. And you can see the charts are moving almost identical to each other. But there are times they do not correlate as highly. One might move more to the downside or upside, especially with stocks. You get earnings at different times and news on companies at different times. So you can get some slight variances in the movements between related securities. When it comes to futures, I have a resource that's pretty cool. I use this mrci.com, and there you go. I'll put this in the chat for you. Everyone. And it's actually HTM. This part is free if you go through the website is put there. But if you try to go through mrci.com, that is a paid site for futures. It's good. Don't get me wrong. There's a lot of good information I use there, but you got to pay for it. So if you're interested, you can sign up for them. Doesn't, you know, if you don't use them, don't pay for it if you don't need to. But you can also get a 10% discount on a yearly subscription for MRCI if you're interested. Anyway, this part is free. For the 10% discount on MRCI, you just have to use my name, basically. let's see, 10% on basically use the word wealth and Brandon as source. There you go. So I'll just show you real quick, MRCI. Like I said, if you go to the main page for MRCI, you're going to have to log in. I'm not sure if I'm still logged in or not. I was logged in earlier. Yep, I'm still in. So it basically gives you a lot of correlation information and futures seasonal information. So again, that's a totally other topic. I've done that before, but if you end up signing up, you can see you can get a 2-week free trial there and you can purchase subscriptions. But if you decide you want it, the MRCI online subscription, instead of $379, it becomes $341 if you use that code. So anyway, that's another topic. So getting back to this free part though, if you use that website that I just put in the chat, it'll take you to this page and it's showing you intermarket correlations for the last 180 days. And you can change the timing here to last 30, 60, or whatever. Now, this is applied to futures, but obviously indexes and futures move pretty similar to each other as well as currencies. So the way you read this is, let's say I'm looking for something that positively correlates with the S&P. It shows you if you hover over the names, which contract it is, June 2023 S&P mini. And as I look across, for instance, here we see that we have a 90% positive correlation between the S&P 500 and the Russell 2000. That's a pretty high positive correlation. Typically, anything above 90% positive correlation, meaning they typically move together, that'll be colored in green. If they move inverse of each other, that would be a negative correlation. And if it's a very high negative correlation, negative 90 or lower, it gets colored in red. So they typically move opposite of each other. So obviously we're looking for high positive correlations when we're doing studies to see what moves with our security and what can we possibly compare to see who is leading or lagging. So for instance, precious metals, we could take a look at gold versus other precious metals. So as I go across, there we are, went too far. We have platinum and silver. Well, platinum is only 64%, while silver is 78%, and copper is 88%. So we have gold and copper moving very well together currently. The question came out, do I use this in the spread alerts? Yes, actually, I do this to not necessarily the alerts, but to let me know where to start looking for spreads. So yes, I do, and I'm actually working on my spread stuff today. I put out my video every weekend for the Wealth with Spreads. So I'm gonna get my list right here. There's your intermarket, so I can scan. And I use some other tools too. But anyway, this is showing you the correlations so you can see what is related. And the closer you get to zero, basically negative 10 to positive 10 on either side of zero, if you're within that range, you have almost no correlation. And that's actually really good for investing purposes. You know, when you think about it, you want to invest in things that are non-correlated, so you're literally diversified. So for instance, we have euro dollars, ED. Okay, now that is not the Forex. Be careful. You know, EU, it says euro Forex. ED, they have little blue pills for that. No, sorry, I always say that is bad. But the ED is euro dollars, which is actually US dollars deposited in European banks. They take a tally of that every day and they create a number, an index that tells you how much is deposited. Anyway, the reason why I bring that up is you can see that is a zero correlation with the British pound. So if I were to take a trade on both the British pound and euro dollars, they should have no influence on each other, and I'm diversified. You know, you're basically looking for things that are not correlated when you're trying to invest to diversify. That's all. So anyway, this is one way we can try to find what might be related to each other. Okay. What correlation gives me heads up for spread trades? Well, again, I'm looking for high positive correlations typically. So that way I can see that they move together. So I'm usually looking for at least 80% or higher Obviously 90% or higher is better because I'm looking for two securities that typically move together, and then I'm going to trade them when they go kind of out of whack, so to speak. And that kind of brings me to my next point here. We look to see who is leading or lagging, but another clue that we can typically get is when you have high positive correlations breaking down. And this could happen as quickly as intraday. So if you have two securities that normally move very close to each other, but for whatever reason that correlation is breaking down, either one took off without the other, or they switched leadership, things like that, that's a warning sign that there may be a trend change coming. So that in itself is a warning sign for the spreads, actually. So whenever you get that divergence, and you see it back on that chart I was showing you here, if I go back to the comparison chart, right here, there we go. Come on. It's not letting me move this for some reason. Anyway, there we go. Back to where it was. You can see when they were together, the trend was very bullish. Okay. Get a little bit of separation here and they turned down, moved up again, very close to each other. Once again, notice the Dow separated from the NASDAQ, actually separated from all the other securities. And what happened? When you got that separation, that correlation would have been breaking down and you get a trend change. So not guaranteed, and there's not a perfect measurement for it either. But typically, when you see two or more related securities moving apart from each other, take off this. There we go. Let's get a brighter color so we can see that better. But when those correlations break down and you get that separation between related securities, expect a trend change pretty soon. Okay, it's not perfect because again, maybe you thought that this was separated here and it got separated further. But again, we can look for some clues. I'm going to show you how that works. So we got the trend change back up. We didn't really get any warning here. Right now, we've got a big separation. So we should be expecting a trend change relatively soon. When? Don't know. We can't tell from this chart, but we can tell from other things. I'll show you in a moment. Okay. So one of the big ways that I use this, question here. Does pairing inverse correlated securities automatically hedge positions? Yes, it can. Absolutely. If you have inversely correlated securities and you take the position, same type of position on both, you go long. Obviously, if they're very highly correlated, you have to do what's called delta neutral for that position though. Meaning when one goes up, the other goes down almost the exact same. And the way you do that is by trading more of one contract than the other. But yes, you can actually create hedges. For instance, if we go back to our negative correlations, the US dollar has a negative correlation with the euro. They move opposite almost 100% of the time. So if you were to buy the euro and buy the dollar, basically when the euro goes up, whatever money you're making on the euro, you'd be losing on the dollar, almost exactly the same. So you're hedged, you're neutral. You lose on one, make on the other, and vice versa. So yes, you can definitely do hedging by creating a negative position, or sorry, the same position in a negatively correlated security will create a hedge, plain and simple. And that's one of the things I do when it comes to spreads. I have to weigh these out. We use what's called notional value. When we take a look at a security, any security, you actually have two prices. So let me get rid of this guy. For instance, ExxonMobil right now, my price is $109.86. That is the market price. However, if I were to take, let's say, 300 shares, the notional value of that would be the actual value of those shares. Oops, didn't mean to do that. So is 109.86 times 300, and I didn't do that right. 86 times 300. The notional value of that position is $32,958. Okay, doesn't matter too much on stocks, but when you go to futures, for instance, NQM 2023, the market value of the NASDAQ is 13,233. So the market value of a security is what you see on the chart or quotes. The notional value is the value of the position. And basically the way we get that notional value, it's very simple. It's the market value times the point value for futures. And that's futures. Or position size. Well, it's stocks. That's all it is. So in this case, the notional value of the NASDAQ right now is not 13,000. It is 13233. I'll say 234 times $20 a point. It's actually $264,680. That is the current notional value of the NASDAQ because the point value is $20 a point for the futures contract. So if you buy one futures contract, that's actually what you were buying. You're buying $264,000 worth of a security, and you're buying it at that market price. Okay. So that's important when we're comparing things for a spread. A spread, by the way, if you're not familiar, is simply trading one security against another. You're trying to trade the difference between the two. So going back to the comparisons, actually, I'm going to go back to this program right here. And the reason why I'm going back to this program, again, we can look in the beginning of the day. I'm on a 5-minute time frame looking at the Russell in green, the Dow in blue, NASDAQ in this fuchsia or pinkish color, and then the S&P in black. Okay, I can see the scales right there on the top. So this morning, for instance, we were rallying a bit, and it looks as though we topped out right around 11:30 this morning here. Okay, and from 11:30, you could see that the leader was the Russell, and we also had some separation as well. I mean, we had separation before that, but finally got separated enough, they started turning. So if we know that the Russell is the leader to the upside, how do we time that turning point? Honestly, these other securities didn't even turn yet, but they may pretty soon because the leader gave up. Unless, and this is the one problem with this, because by the way, in technical analysis, everything happens except when it doesn't, right? There are no 100% guarantees in technical analysis. We try to weigh the evidence in front of us from the charts and the information we receive and get an idea of what's likely to happen. But of course, we can be wrong. The market's not wrong. We could be wrong. And it happens. So anyway, here, the Russell was the leader this morning. So when we look at the futures contracts, and I have all of them up here, actually we'll do, there's the Russell 2000, going to the full-size contract, and you can see that from 9:30 this morning, when the bell rang, the Russell took off to the upside. And now it's actually changing trend a bit. We have lower highs and lower lows. So when I look for, if this were the leader to the upside, after that market opened, I would be looking back to see where is it likely to turn. And I would be looking for what we call an area of supply. I don't know if we have one right here where we turned. Might not, actually. It's kind of interesting. Oh, there we go. Well, we had one lower as well. It depends on the time frame we're using as well. Probably could go a little higher, but I'm on a very small time frame here, 5 minutes. So there was an area of supply right there. Obviously, we went higher. We'll see if we stalled out though along the way. And that's not a good one. This is the origin of the move down. And actually, just real quick, if we keep going higher today, we'll see. I probably should look at a higher time frame, honestly. That'll be where the trends really turn, but at least I can give you an example of the pauses and how they work. So, getting back to where we were, there we are. This morning, the market opened up. right there. And as I'm watching the leader to the upside, remember this led very early in the morning. It was the leader. Let's see, when did it actually emerge as the leader? Pretty much right away. In the first 10 minutes of the market open, that emerged as the leader. And it pretty much stayed that way until 11:30. So I would be looking at that leader to know when the other markets are likely to stall and turn down. And actually, the Dow in blue was one of the weakest markets this morning. And therefore, that might be the one I'm looking to short if the market turns down. As the market's moving up, you typically want to be long on the strongest market. And if the market's turning down, you typically want to be short on the weakest market. Of course, maintaining the overall trend. You got to keep that in mind. You don't want to trade necessarily against the trend. So as we moved up, again, on the Russell, you can see we came up to this 1807 first level of supply, and we started to stall. We got a red candle there. Now, did it change trend? No, it's just a pullback. That's all. And we just kept going. Come up to the next level. Notice it's stalling at that supply as well. We still have plenty of momentum. And of course, I can look at the bigger time frame to see if the trend is going to continue or not. And there are clues that I look for that trend as well. And just keep in mind, all these things that I'm talking about right now, if you become a member of the E-mini think tank, there are videos that explain all this. Right here's trends, right? And I've got all this stuff about, futures basics, how to place orders, traps, all kinds of stuff, how to find zones properly. And with every one of those bonus videos, there's always documentation that goes with it to teach you, and you get to download those and use those. Of course, we trade live with each other 3 days a week, or I trade in simulated mode just for legal reasons, but we get to look at the markets live 3 days a week and practice. So anyway, we see this pulled back at the next level supply, and actually is turning down now, changing trend a bit. So like I said, if I go to the bigger time frame, well, there's not really any trend warning here. I go to the bigger time frame. Let's see if I got anything there, because this may just be a pause right now as well. Yeah, this is not a turning point. This is just a pause point. So we're getting a little bit of a correction right now. And as I was saying, since this was pausing, remember, this was a leader to the upside. You take a look at one of the weak markets, which in this case was the Dow. And again, as the markets were going up, that was the opening bell. This was being dragged to the upside, but it wasn't going up as much as the Russell was because that was a leader. So we may not have hit supply. Let's take a look back. Let's see, where is it? And see what happened when the Russell, the leader, hit supply. Was the Dow hitting supply as well or not? Because it doesn't always need to in order to turn. If the leader hits supply, that's where the laggards will follow. Got to go back a while to find it though. There it is. So that was a tested area. That's not a good supply zone. I'm going to keep looking for a good zone. And unfortunately, whoops, there it is. May not have anything great because of the rollover. I should have used a continuous contract, but this is the beginning of a little drop right there. There's also possibly here with more selling pressure. And I don't know above that. So you can see that, no, there's nothing that told us we were going to turn necessarily at any one of these pause points, at least not on the Dow, because the Russell was in charge. Since the Russell was a leader to the upside, the Russell let us know we were going to have pauses, not the Dow. The Dow was just simply following along. And you can see, well, we did pause right here. Again, this was a tested zone. It had been there a couple times. So when the Russell stalled, the Dow stalled with it. But these other areas didn't really mean anything to the Dow. And yet they pulled back. Why? Because the leader that was dragging everything upwards, think of it like this. The Russell is a helium-filled balloon, and the Dow, the NASDAQ, and the S&P right now are weights attached to that balloon. And that balloon is causing the weights to rally because it's big enough of a balloon, it can pull them upwards. But if the balloon pops, those weights will fall. So right now, remember, the Dow was the weakest market, right? Let me get rid of these. If we want to know when it's time to go up again in the Russell, we look to the Dow. And the reason why is the Dow is pulling everybody down, but when the Dow stops moving down, that's when the balloon fills up again and will rally. So if I'm looking at these and looking at the correlations, again, from this morning right here at the opening bell, the Russell's the leader upwards. The Dow, as of now, and again, they can change, but as of now, the Dow is leading us downwards. When the Dow finds its footing, that's when those leaders will go back up again. Unless they switch leadership, of course, which can happen. I can even look from the highs here. You can actually see from that high today, the Russell's actually dropped the most. So they are kind of rotating a little bit, but overall, I'd still probably look right now to see, oops, there it is, where the Dow might bottom out. Well, we're actually at a little bit of demand right here on a small time frame. You can see we have a little basing and a rally area. So if the Dow stops moving down right here, that strong Russell might be able to rally upwards from here. If not, it's not a great area there. I would actually probably look, that doesn't look good either. So we might be able to fall down a little more. Now, let me show you what happened the other day, because there's a great example of this with basically gaps. So what I'm going to do here is something a little different. I'll just go ahead and copy this chart. Let's see. Copy. And let me do this page. Create a new chart page. Hopefully this will work. Sometimes it freezes up and I hate that, but if I have to, I could probably go to a different program anyway, but I wanted to be able to show you multiple securities together. And my normal gap page is not working, so that's why I got to do it this way. Actually, that's good. We can do this. So again, if I go to ES, and what I'm going to do is just electronic trading hours only. See how that works. And I'll keep it on 5 minutes. Okay. Let's see. Can I copy this chart? No, I don't want to. Let's see. It's not copying. I might have to create new charts. That's okay. Yeah, just do that. Okay. So chart, new chart. It'll be quick. NQ1 continuous. Bingo. Another chart. YM1. And just creating continuous contracts on the 4 equity indexes. And the last one, it's RT1. There it is. All right. And finally, there we go. So going into, this is the 5-minute charts on all these securities. And I'm going to go back a little bit here to, not today. Actually, it might work today too. I'm not sure. But it was a couple days, or yesterday. Okay, so there's the 30th. We go back to the prior day. And on the prior day, basically we had a gap up on all the markets. We had what's called an outside gap. And when I look for these gap trades, and again, this is a strategy that I teach. If we go in, you can see on the videos, where is it here? Oh, there's something on gaps here somewhere. Yeah, it's in the Globex traps. There's also gaps in there as well. And again, there's documentation, I believe. I'm not sure if it's here or if it's in the other strategy. Yeah, there it is, Globex traps and gaps. So I teach, like I said, in depth how to actually handle this and deal with this. But there's basically what we call an outside gap going on here. And typically what'll happen is when you come back to close the gap, you'll only go to the prior day's high. So there it was on the S&P. Okay, and that's from the 29th and the 30th. If we take a look at the NASDAQ, bring this back a little bit, again, shrink it down. Go back to 29th and 30th. It was pretty much the high was almost the end of the day. It was the second to last candle of the day. Let's see, we got a question here. So not using any other indicators other than the candle, moving average, Bollinger Bands help or hinder. It's up to you. You know, price is everything. Price really tells you what's going on. Technical indicators are, first of all, are all based on past price, right? So they're telling you what's already happened. And the signals you get from them are typically lagging. The buy and sell signals happen after prices have moved away from supply and demand. However, they can be helpful for filtering trades possibly, or even giving you confirmation on your zones. So I use them as kind of a decision support tool, not necessarily the tool to tell me when to buy or sell. Yeah, price always tells me when to buy or sell. So yeah, I try not to use indicators too often. I do use the RSI, but I use it in a modified manner, not the way that is normally taught or used in in all the books like that about technical analysis. Okay, so there we go, got that. And the one thing I'm missing is my percent change chart. So basically what happened on yesterday morning, we had gaps up, as you can see, on all four indexes. And we had the outside gap. We were above the prior day's high. So what you need to do is figure out, okay, which one is leading us down? Because when that leader hits that prior day's high, that's when we're likely to bounce. And you can kind of see it right here. Notice the Russell pretty much rolled over and tried to close the gap right away. Same thing with the Dow. Those are weak indexes and trying to drop and drag everything down. The NASDAQ did go down a little bit, but it also made a higher high. And what time is that? About 10:30. You can see the Russell at 10:30. Well, not quite there yet. There it is. You can see it was dragging everything down. That's 10:20. So 10:35. Basically, we bottomed out right here on the Russell about 10:15, 10:20, and that allowed everything else to rally. The NASDAQ was the strong market, and it's the one that was leading to the upside. When it got weak, that's when everything will turn down. But the weak markets, when they bottom out, that's when everything will rally. So if I'm trying to figure out where that gap closure is going to end and we are going to be able to buy, I look for that leadership to change trend direction. And it tells me then I'm going to buy the NASDAQ or buy the S&P because they were the leaders. Let me see if I can do this right here. Let's see. Yep, that's what I needed. And unfortunately, I have the wrong symbols up again. So let's do ES. It's only take a moment. And Q. YM. And oops. TY. There we go. And we're going back to 5 minute on the 30th. Just got to go back to that time. There we are. So looking at the chart, again, this is on the 30th after we had that gap up. You can see that the NASDAQ was emerging as kind of the leader to the upside. Initially, it was a Russell, but then it became the NASDAQ about around 10:30. And the leader down emerged as the Russell. So the NASDAQ was not going to be able to rally, neither was the S&P until the Russell decided to bottom out. And you can see it didn't bottom out really until about 135. So we go back to our comparison charts, and you see lower highs bouncing off of selling pressure right here, still going down. And the NASDAQ had no choice but to go with it. It was fighting, trying to stay up, but getting dragged down by those weak markets. Drag this over a little more. And the S&P, same thing. It wanted to go up, but it could not, simply because the Russell was dragging everything down, along with the Dow to a certain extent too. And there you see, it's about ready to hit that gap. What time was that? 11:40. And the NASDAQ, not even near it because it wants to go up. And it actually went through the gap closure, didn't bounce, and we saw when it bottomed out, that was at what time? I said 135, basically. So if we go to that 130, looks like it was a little later, about 145, honestly. Whoops, wrong button there. So that's where it bottomed out. Remember, this was the leader to the downside, dragging everybody down. So we'll go to the Dow where it bottomed out as well. Right around that 130 area. Actually bottomed a little earlier here. But definitely right around, oops, come on. There. So the NASDAQ, remember, that was the strong one, the one you want to buy. It was pulled back until, where's the 130 area? 13, it was actually a little later, 1350. It really got dragged down. And finally, the S&P. So this whole time, I would be focusing on the Russell to let me know when it's done going down and ready to rally. And what I would do then is take a look to see, is there an area on the chart that tells me we're going to bottom out there? And it wouldn't be on the 5-minute time frame, by the way. It would be on the bigger time frame. So intraday, it might be something like the 60-minute. And you can see right here, this is where we started our rally before the gap up. Actually, this is about a 5-minute, I'd probably use a 30. I use certain relationships here. And look at this. The Russell hit the origin of the buying pressure right there, about 1:30 in the afternoon. And because it was done, it started holding the leading market to the upside, which again, if we look at the comparison here, around that time, the NASDAQ and the S&P were the two strong markets. Those are the ones you want to buy because the leader to the downside finally hit demand. Look at that rally on the NASDAQ to the end of the day. And the same thing on the S&P, rallied to the end of the day. But if you had bought the weak market, it didn't go anywhere. Even the Dow, well, the Dow rallied quite a bit, but the leader to the downside, the weakest market, pretty much didn't go anywhere by the end of the day. Even if I go down to a small time frame, get that out. There we go. You can see it really did not go very far, but it hit demand and allowed the leaders to the upside to bounce. That's what that can help you with, is identifying when the markets are going to turn and which markets to trade. So from that bottom right around 130, by the end of the trading day, you can see that the NASDAQ rallied the most, a little over 0.5%. The weakest market, the Russell, didn't rally as much. Wouldn't have made as much money going long on that security. So you got to find the leaders and understand when those leaders are telling you things are going to turn around. Now let's take a look at the NASDAQ here. And on the NASDAQ, that demand zone that we saw on the Russell on the 30-minute time frame was down here. Okay, this was the prior day's low. You could see we never hit either one of those. If you were solely looking at the NASDAQ, there was no signal here telling you to take advantage of that rally. The signal to go long on the NASDAQ came when the leader to the downside, the Russell, hit that buying pressure. That was it. Again, that was on 30 minutes, sorry, on the wrong time frame there. There it is. So that's why I pay attention to leaders and laggards, because the leader to the downside, when it bottoms out and the trends change, the leaders to the upside will be free to rally. The balloons take off. And let's see, did the S&P hit anything? Well, the S&P simply hit the prior day's high. And again, that was the buying opportunity because it was hitting the prior day's high while the Russell was bottoming out and hitting the trend change. And I don't know if the same thing happened today. We did have a gap up again today, right? So if we take a look back, oops, wrong one. Let's see if it followed through today as well. There's the prior day's high. So Thursday's high right there. And we tried to come down to it. We opened just above and took off. Today on the NASDAQ. Yep, this is it right here. Again, go down to the smaller time frame, 5 minutes. And get rid of the annotations. There we go. So the prior day's high, 330, I guess it's this candle right here. Overshot it a little. Now, I don't know who the leader was this morning. We'll have to take a look. And the Russell also came down a little bit. This one actually was an inside gap. So when I have mixed gaps, I can't actually trade my gap strategy. I have to look for something else. And you can see right here, we take a look at the Russell. There's the prior day's price action. And we opened inside of the prior day's price action. So again, not all the gaps were doing the same thing. If they're mixed types of gaps, I can't do the trading strategy anyway. But if we take a look to see this morning, before the market opened, I am on the 5 minute. Here we are. And that is this morning right there. Looking just before the market opened, right around 8 a.m., that's when the market makers start getting a little more active and the volume picks up on these securities. Yeah. Wasn't really, I guess the NASDAQ was the leader. The Russell was kind of lagging. Although right before the bell rang at 9:30, you see the Russell emerged as the leader. So you'd be looking to buy the Russell today. And then there's the bell. And you can see it gained the most this morning, while the Dow and the S&P were kind of lagging behind. And since that time, you would have made the most profit buying the Russell, while you would have not made as much by buying the laggards. So why do we top out here at about 11:25 today? Well, we'd have to take a look at the Russell to see where the topping happened. It's probably at a higher time frame supply zone. I don't have all the data, but look at that origin of that drop right there. That's the selling pressure that caused the Russell to top out and is now allowing the weaker markets to start moving down. So that is a little bit about following the leader. Fortunately, I'm out of time here. I got to get going. But if you want to learn more, like I said, you can join me in the E-mini think tank. You can hit us up, support at wealthbuildershq.com. Basically, if you subscribe to the E-mini think tank, the first 2 weeks, if you do a quarterly subscription, it's free. You can try it out and see if you like it. You get access to everything, all the education and the live classes, the recordings. So you can try it out for a couple of weeks. If you decide it's not for you, then you just cancel. No harm, no foul. We don't even charge your card for the first 2 weeks. So then if you decide to let it go, then it just charges and renews every quarter. If you want to do monthly subscriptions because you're afraid of a long-term commitment, just want to try it out, you can do that as well, but there's no free trial for that one. The free trial only comes with the quarterly subscriptions. But let's see. I don't have my links up. I don't know who's my admin here, but you can go ahead and you got the link to put in for the E-mini think tank. If you want to try it out, like I said, you can just go ahead and see. I think I have it here. Yeah, there it is. Is that going to go? Yeah. There you are. So there's the link if you're interested. And like I said, you can do, if you click on that link, hopefully it'll open up my browser for me. There it goes. There it is. I clicked it too many times, but you'll see at the bottom, you can register either monthly, or if you do quarterly, as I said, you get the 2-week free trial. So you can try it out. We don't charge your card for the first 2 weeks. And if you cancel within that time, again, you got to full access to everything to try it out. If you decide to let it go, then you just get quarterly billing on that. and it's auto renew. Same thing for the monthly. You could try it out for a month. If you like it, great. If not, well, then you just cancel. So if anybody has more questions, again, I can give you the email address. It's support at wealthbuildershq.com. So, thank you, Jim. I'm glad you enjoyed it. And everybody have a great weekend. Trade safe, trade well. So thank you very much for being here. Appreciate it.